All right, so we just started to record, and we're going to open this up in prayer. So if we would take a moment. Dear God, we are so grateful to be here once again in your presence. Thank you for this opportunity to come together through this technology to listen to the speaker. Bless her family, bless everything that she will tell us today. Bless his ministry, bless our church, bless everybody who's on this call and all those for whatever reason could not make it. Let something be said, heard, that we can go out into this world and spread the good news of your Son, Jesus Christ, and that we can handle our finances, handle our taxes in such a way that it's not selfish unto us, but can lead to the betterment of our community and other people's lives. It's in your Son, Jesus' name, we do pray. Amen.
Amen.
We welcome everybody to another meeting of the Personal Finance Ministry of Third Street Bethel AME Church. And we're going to continue our speaker series, and we are so excited to once again listen to our very own Gwen Carney. And as many of you all know who she is, she's a certified public accountant, many years of experience, who does great work for her clients and her church and her community. I also want to give out a shout out to James, who's who's our backup today, but her husband James, so he's
Behind the
behind the
scenes.
scenes, but they're a great team, and we welcome both of them, and we are so blessed and thankful that you all are here. So, further ado, Gwen, you want to take it over?
I got it. First of all, good morning to everyone.
Morning,
Hopefully,
Gwen.
everyone can hear me. At some point, I will share my slides at the end of this presentation because I don't want you reading ahead of me. So you will, though, however, need to take some notes because I am so sure that something will be said in our discussion that may not necessarily be on my slide, but you may want to take notes as we're going along. First of all, thank you for joining us today. I'm going to try to keep this to the 2 hours as promised. You just never know, but let me start out with this. Sure, I do taxes. I've been doing taxes a long time, but there's not near a soul that I know of that knows everything there is to know about tax preparation. There are too many laws for us to keep any of it or most of it in our brains because we can't. So we have to research a lot of subject matters because taxes are always, the law for taxes is always changing. Every year something changes. And so we have to try to keep up with it. So the best I can do is talk about the things that I am most familiar with. If you ask me something that I'm not familiar with, if I can find the answer for you, I shall. But just keep in mind, I'm not everyone's personal tax preparer. So I can not give an opinion on what you need to be doing with your taxes. If I am your preparer, then you know how to contact me and we'll do your information separately. Okay, so I'm not here to give advice. I'm only here to educate you on the things that I know about. Yes, I've been doing this a long time. Yes, I am a CPA, but this is probably my favorite time of the year. I do like doing taxes. It's a number cruncher and it requires to research. And every time I turn around, I got to look up something else because somebody brings something unique to the table that needs to be researched. But then I'm also wish one day I will be able to write a book because I've been asked questions um, that honest to goodness, they make me sit back and laugh sometimes. Like I had someone that asked me, could they claim their horse? Now, horses don't have social security numbers, so of course you cannot claim your horse. But in a nice way, I will say, no, I don't think that is covered in the law. But I will do the best I can this day and just understand no question is dumb. Please, if you need if if you want to write a question in the chat, feel free to do so. I'm sure Dr. Johnson is monitoring it. If you need to stop me, raise your hand or so that they will acknowledge that I need to stop and answer a question, and I most certainly will do so. So with that being said, I am getting ready to pull up and share with you. Can everyone see my presentation? And if not, just let me know. I'll have to figure it out. So am I able to share yet?
Yes, but we don't see it yet.
Okay,
No.
wait a minute. All right, wait a minute. I know my husband will probably say, now, didn't I show you how to do that? Oh, Lord. Okay, so I gotta hit share first. And then I gotta go to my document I want to share, which is right here. I'm gonna say share. And then I know I need to. He's coming down to help me now because here he comes. He's like, okay, I found it, baby.
All right. Yay.
What you need to know. But how do I go back to the first slide I had? So I'm on the slide. No, not that one. I'm on this one. Yeah, that's why I'm at. So
Let's close that.
well, I can start from here, Jay. It's fine. I can start from here. All right. So what you need to know for this tax season, let's do that first. All right. So everyone should know that tax season has already begun because I've been doing taxes since January the 26th. I had some that gave it to me January 15th, and I had some that had to wait a minute because it's not until the IRS says we're allowed to file taxes with them. We can't do a thing until we're allowed to file taxes. Then extensions are also granted until October the 15th, but you have to ask for an extension in order to get that extension granted. So it doesn't come automatically, but understand this. You can ask for all the extensions you want. The government wants their money by April 15th. So when you're asking for an extension, that's how come tax preparers cannot send in an extension for you. I can't send. How am I to send in an extension for you if I am not sending in any money? That's what an extension is. An extension says to the government, hey, I don't have time for the paperwork, but here's your money. Well, I can't, no need me sending in an extension if I'm not sending in any money. What is it that you're extending? Just think about it. It only extends paperwork. It does not extend the actual payment of your tax bill. And that's if you have a tax bill that's due. So I tell people it's very simple to file an extension online and send it in, but you have to send in the money. The next thing we need to know is that, yes, contributions are a very good way to be able to itemize, but in a little while, when I go through samples of tax returns, you will see there are some lucky folks this year that are not going to have to itemize in order to get a very nice tax return, a lower tax rate. But I will go over that when I get to the big, beautiful bill. But look at this, up to 60% of your adjusted gross income, you're allowed to contribute to nonprofits, to churches, so have you. But the average person doesn't give away 60% of what you're going to live on. If you give away 60% of your income and the government takes 20% of you in taxes, well, you ain't got but 20% left to live on. So that's virtually, now I'm not gonna say impossible, but unlikely that you're going to be putting away 60%, giving away 60% of your income. So most likely you will be able to deduct contributions providing you are itemizing your deductions. You should be able to. The next thing is that there are 7 brackets, tax brackets. And when I say tax brackets, I am speaking on What is your rate that you're paying taxes? What's your tax rate? Now, everyone's tax rate is different. It all depends on where you fit on the scale. Because when I say where you fit, there are some people who we have no choice but to take the standard deduction that's being allotted to us by the government because we don't have the ability to itemize. And we don't have the ability to itemize. That means that we have to take the standard deduction. So what I'm going to show you in a little bit will be the listing that shows you those 7 tax brackets. But understand this. If you don't itemize on the federal return, you cannot itemize on the state return. So there is a benefit to itemizing, and I'm not saying we shouldn't, but what I'm saying is that in the case of the state of Virginia, because when I get to those slides, you're going to see that the state of Virginia does not care whether or not you're single, married, divorced, head of household. What we all pay the same tax rate. It doesn't matter. It's based on how much money. So if we're able to reduce our money, taxable money, by itemizing it on the federal government, then it helps us with the state to be able to reduce our taxable income to them as well. But we'll talk about that some more later when I bring up the state of Virginia. This year, the child tax credit is up to about $2,200 per qualifying child under the age of 17 at the end of 2025. Okay, so I try to be funny, but if your child turned 18 on December 31st, the answer is no. You're not going to get the child tax credit. They have to be under the age of 17 at the end of 2025. That is the way that goes. So now, those of you who got those side businesses going on, or have folk giving you money through PayPal and Venmo and eBay or all that. Okay, so now the government is making those third parties give you a 1099-K, which reports to them how much money was given to you through those avenues. So they have raised it. So look, it says if your payments received are 20K or more. So you must be in business or something if you got 20K coming to you through these venues. Or if you have more than 200 transactions. So that ain't got nothing to do with it. You got 200 people give you $1 a piece, you're going to get 1099-K. Because there are 200 transactions or more means that you're going to get a 1099-K. And so I have been asked the question, so what am I supposed to do with this? I'm not in business. I didn't do anything. I was helping people out. I loaned somebody some money. They gave my money back to it. Okay, you know what? That between you and a third party. Okay, because your tax preparer can't solve that. Your tax preparer must still key in that 1099-K as income because we're your liaison. I get it. But we don't solve the issue with third parties as to why you got it. Have you ever received a W-2 or 1099 that's incorrect? We can't fix that either. You have to go back to where it came, the source from which it came. So these are just some things you need to know right now for the federal taxes. And I'm going to get into that big, beautiful bill in a few, but I wanted to be able to show you next what the tax rates look like. Okay, so there are 7 brackets here. And it all depends on where you fall. So either you're single, you're head of a household, you're married, filing jointly. Now, if you're married, filing separately, that's the same rate as single. It's just that I didn't get into it, but that's probably the worst way to file a tax return is married filing separately because not only does it put both sets of income in a higher tax bracket, but it also eliminates some of the benefits that you could have gotten. One of them I could think of at the moment is that if you're married filing separately, I think you lose the benefit. If you're carrying a child on your return, you lose the benefit of getting the education credit, for example, for tuition paid. It's not deductible, credit if you file married filing separately. So there's some other things that affect those that do that. But the reason I put this up here, because you really need to pay attention and understand the definition of head of household. Yeah, we all think we are head of our household. Who doesn't think they are head of their household? But head of household is for those who are taking care of a dependent. That is what's making you head of household, because you have a dependent on your tax return. But if you're married filing jointly, you can't be both. You can't be married filing jointly and head of household. You are married filing jointly. This is for single people, head of household. Either you're single with no kids, or you're single with kids or dependents. Let's put it that way. So I needed you to see this rate, tax rate. And I'm going to pick on two of those tax rates. And when I get to the samples, I'm going to pick on two of those tax rates. And for those of you who are really smart, take your cell phone right now, and take a picture of this screen, because I'm going to come back to this screen to prove my point, and where I'm going to zero in on, so you'll know. I am going to mess with a single person that could be paying the 12% tax bracket versus the 22%. Just see that. And then slide yourself over and look at married filing jointly. I'm going to also give you a sample showing someone married filing jointly who could have been paying the 12% tax bracket, but they're paying 22% because they didn't itemize. Okay, so I'm going to show you both scenarios. So if you could take a picture of that screen while it's there, you'll have a reason to go and understand why I'm going to go back and tell you about those numbers in that screen. Okay, so next, we're going to talk about the standard deduction, and this is the other screen that would be necessary for my scenario for you. Where I talk about how the government time has changed the amount of the standard deduction, but it works two ways. If I'm single, sitting in the year of 2025, the government says you can reduce your income by $15,750 without proving anything. You don't have to tell me how you spent the $15,750. I'm just going to go ahead and reduce your income by it. But for those of you who want to pay less tax, you need to get above that $15,750 in order to itemize. That's what it's telling you. So every year we've got to do more. Every year we've got to do even more to be able to get past the single or even the married filing jointly. Look at the poor head of household. The head of household has to itemize over $23,625 to be even able to itemize. You have to have deductions that exceed that amount in order to be able to itemize. And married couples, you need over $31,500 in order to itemize your deductions. I'm not going to say that's not possible, because it most certainly, and I'm going to prove it to you in a little bit, it is possible to exceed that, but you got to have certain things going on. Okay, so if you, for example, if you're one of them people that doesn't have a mortgage, for example, well, then you need to be giving away quite a bit of money. That's the only thing I can tell you. You ain't got no mortgage, then instead of giving to the mortgage company, you ain't got to give to the mortgage company. You need to give it to church. You need to give it to Goodwill. You need to give it away, okay? Because that is the only way you could be able to itemize your deductions, is to exceed that. So you're going to see, some people, yes, that's difficult. It's hard to get past those figures, but that's intentional. by the government. Okay, this is not made up. They do this every year. If you just look back at 2021, a single person didn't need but 12.5. Now they need 15,750 for the same itemized. Okay, that's why I have this up there to show you how it gradually increased every year, and it's going to keep on increasing. They're not stopping. It's going to keep on increasing, which means we got to do more in order to be able to itemize our deductions. Okay, so I needed everyone to see that so that you'll understand um, what's going on here. And the next slide I'm going to show for those who are doing earned income credit. It shows you the maximum amount of money. And just look at this, someone with no children, none, and the income is doesn't see 19,104. Hey, Randy, those that those with income that don't exceed 19,104 can still get $649 in an earned income credit on their tax return. For real. Now, I don't remember because I didn't research it before I came on today, but there also is an age limit too. In other words, I don't know if the single person got to be 25. I can't remember. I don't remember what it is, but there's an age you have to be if you have no children, in order to get that earned income credit. Okay. All right. So before I'm going to get into the big beautiful bill. I just need to know, does anyone have any questions on anything I've already asked? I can't see this chat, so I don't know if there's anything or anyone wants to raise their hand and ask a question before I get into it. And then Zelda, can you tell me, will I be able to share? How do I close this down at the moment to be able to share another slide that I have that's not a part of this one? Will I be able to bring up a second one that I have?
Yeah, just go to the top of the screen and hit the red button that says stop share,
Yes.
and then go back and
Oh,
reshare.
and reshare. Okay, thank you. All right. So I'm getting ready to reshare. Okay, so can everyone see what I just brought up? It's a Excel spreadsheet that shows you some figures.
Yes.
Okay, now I'm gonna tell you now. When I say this is the screen that you need to take a picture of, this really is a screen you need to take a picture of, because I want to explain this one, because this will prove my point about how standard deduction differs from itemized deductions and how it can affect you. So I'm going to pick on the single person first. So just understand, the first example I'm giving you is, if you're a single person under the age of 65, and I am pretending that your income was 70,000 for the year. So just understand, I'm just pretending, I'm making this up. But 70,000 for the year is your income. The government says, well, standard deduction is 15,750. Your taxable income becomes 54,250, and you are now paying a 22% tax rate on that 54,250, because that is what you have to pay. The very first screen I had you pull, it showed that if you were single and your income was between 48,476 and 103,000, you pay 22%. But then I say, single person under 65. Well, let's pretend we don't want to do standard deduction. Let's pretend we want to itemize our deductions to the tune of 24,000. And look to the right. You will see I came up with that to itemize. Yeah, sure, you got to give away $4,000 in contributions. That's not even 10%. That's not 10% of your 70,000. I said give away $4,000 in contribution, clean out your closet, do something. Salvation Army, do something. But you have mortgage interest. I'm pretending. I know you have real estate taxes. You probably drive a vehicle. State taxes that come out your paycheck, you have no control over, which is 5% in Virginia. So I showed you how to come up with $24,000 as a single person, reduce your $70,000, and now your tax rate is 12% because 12% for single is as long as you did not make over 48,475. I got the income down to 46,000. But if that income was 48,000, my tax rate for single would still only be 12%. So I need you to see that because there is a difference between standard deduction of 15,750, but being able to itemize with 24,000. And therefore your tax rate, 10% difference in taxes is a big difference. Just do the math. Just do the math. That's a big difference. You take 22% times 54,000 and look at 12% times 46,000, and I can guarantee you that's a lot of money. That's a big difference. All right. But then, even though I haven't talked about it yet, and I'm going to talk about it in a few minutes, if you were single and you were 65 or older, then you don't have to itemize because the government gave you an extra deduction of 6,000. So I need you to see if you were 65 or older, you still had income of 70,000, you had a standard deduction of 15,750, but the government, when I talk about the big bill, I will talk about the $6,000 that the government gave you if you were 65 or older. Then now your taxable income is 48,250, and your taxable income is 12%, and you didn't have to itemize. The government gave you a bonus when they gave you the $6,000 off because you were 65 or older. So that's a win-win for those who are 65 or older. Now, and when I get into the big, beautiful bill, you will see it's income driven, okay? Because that figure changes as soon as you make over 75,000 single people, 65 or over. Okay, your $6,000 deduction, extra deduction, is going to be prorated. But I'll talk about that in a little bit. Now I need to mess with my married folk. Because see, my married folk, they need twice as much. So I have married folk under 65, both of you. And I'm pretending you're making the same amount of money as single, but two salaries, making 140,000. I took away the standard deduction of 31,500. So now your taxable income is 108,500. Trust me, the table will show you that if a married couple is making 100, its taxable income is 108,500, you're going to pay 22% tax. No ifs, ands, or buts about it. That's what you're going to pay. But then I say to you, married people, 65 and under, under 65, then how about itemizing your deductions? And we can get that bill lower. So look to the right. The reason I got your mortgage interest higher because y'all living in a bigger house. That's all. I'm just assuming because you're making more money. I'm just assuming y'all's living in a bigger house, okay? So you's paying a higher mortgage than the single people, all right? Because it's two folk with income in the house, okay? So that's why I made your mortgage interest higher, which means if you got a higher mortgage, most likely a bigger house, you got higher real estate taxes. Your taxes are higher. Not only that, but I'm sure y'all got two vehicles, not one, but two. So you get taxes on both vehicles come off. State taxes withheld is 5%. So I took 5% of the 140,000, and that's where I got the 7,000. But now you need to give away $9,000 during the year. You need to give away 9,000. Okay? No, I don't. I'm not gonna say $9,000 is gonna be up in your closet. I'm not saying that. Maybe some folks might be give away some furniture or something, I guess. But I'm saying you're gonna have to give away some money too, okay? During the year, all year long. I'm trying to get your itemized deductions of the 43,500 because if you take that away from the $140,000, then your tax rate now becomes 12%. A big difference. If you take 108,500 times 22%, that is a big difference than 96,500 times 12%. Big difference. But then those of you who are married, both 65 or older, you don't have to itemize because that same income of 140,000, my very last situation there, standard deduction is 31,500. Extra deduction is 12,000 now because each of you gets $6,000 deduction under the big beautiful bill that I'm going to discuss next. And now your taxable income is still down to 96,500, and you did not have to itemize. You are at the tax rate of 12%. As married, provide both of you are 65 or older, your income is at 140,000, but really technically your income can be 150,000. But the problem is that at 150,000, I can't get your income, I can't get your taxable income down to the 96.5. It's a problem. I'm trying to, this scenario is to get your income down to 96.5. So now if you make 150,000, now you can't fit my scenario. But if you're making 140,000, you can fit the scenario because you only have to pay 12%. All right, so I wanted you to have that. Hopefully, you have taken a picture of that so that you can refer back to it. And just remember, this is fictitious, but it's just to make my point. My point is that sometimes it makes sense to do a little bit more so that you can itemize your deductions versus taking the standard deduction. In some cases, it doesn't make sense to try to itemize because the government gave you extra money under the big beautiful bill, which I'm gonna go over shortly. And so does anyone have any kind of question or does not understand that part of this presentation before I get into the big beautiful bill? Because we're going to be a few minutes on that big beautiful bill because some things have happened and we need to understand them better. Does anyone have any questions, Zelda?
Hey, Tony Moss in the chat, he says theoretically for married couple where one is under 65 and one is at or over 65 in 2025, what happens?
So what happens in that case, in this particular scenario, I did not do that one on purpose because when I cannot get your income down to the 96,500, then I have just lost my ability to prove to you that itemized deductions, your itemized deductions will have to go up because the government is not going to give you 12,000. The government is only going to give you 6,000 because only one of you was 65 or older. So it doesn't even fit any of this because you're not going to get 12,000 off as a married couple. So yes, you'll still be in a higher tax bracket. Any other questions?
Thank you.
You're welcome, Tony. Okay, so I'm going to stop sharing this one and I'm going back to my slides as soon as I figure it out. Okay. Okay, can you see my slides? Okay, let's talk about the big, beautiful bill. And I'm going to talk about it one at a time. And we're going to go over each one of these points. If you have questions, please raise your hand, put something in the chat so that we can talk about it more as I go over each point. The first one I want to talk about is Schedule A. This actually is my favorite part of the big, beautiful bill. And what it's saying is for those of you who are familiar with itemizing your deductions, there is a section on there, Schedule A, that talks about taxes paid. It used to have a $10,000 cap that I don't care how much came out your paycheck in state taxes, what you paid in real estate taxes, what you paid on your vehicle in taxes. When you add it all up, once it reached 10,000, the government did not allow you to reduce your income any further. So there are some people who could not itemize anymore because of this cap. Because when you itemize, like I showed you on my other sheet there, you got the married couples had to have on my scenario I just showed you before. Married couples needed $43,500 to itemize with. Well, if you take away a part of the taxes that they were paying, whether it came out their paycheck or whether they paid the real estate taxes on their house, if you took that away from them, then that meant they needed to find another means in which to have itemized deductions that exceeded the 40 some thousand that I gave you an example of. So this is going to help those, especially those who were stopped in their track. So now, sure, if the government, if you working or even your 1099-R, you ain't working with retirement, you're still paying state tax. And let's just pretend that they took $5,000 out of your taxes, okay, out of your checks. And let's pretend that the real estate taxes on your house is another 8. So now we're up to 13. And let's pretend we paid a couple $1,000s to the county because on our vehicles, so that's 15. I'm trying to tell you now, you can take all $15,000. You can take up to $40,000 now, which makes your ability to itemize greater. So there's people who could not itemize last year who may, there's a possibility you may be able to itemize this year. Now, with all things, and you're going to find this out as I'm speaking, that the government always got an issue with those who make over a certain amount of money. There is always, but if you make, and it says, that it's been raised to 20, but if your adjusted gross income is more than 250,000, in the case of married filing jointly, it's more than 500,000, then your overall limit will get reduced from the 40. Okay, so the average person doesn't make that. The average couple does not make that. I only have a few I can count on my hand that make that. Okay, so the average couple does not bring in over $500,000. All right, so because they don't, then most likely they'll be able to take it off. Anyone have any questions on Section A? Any questions? All right, I'm going to my next part of the big, beautiful bill. Now, this is funny and it ain't funny, okay? So now I got folk who did buy themselves a new car in 2025. Yes, you did. But now, you bought it in 2025 don't mean it's new. The definition of new means exactly that, brand new. If you bought yourself a used car, it's new to you. But to the government, it ain't new. Okay? So if it's not a brand new car, off the showcase, out the showroom, it doesn't qualify. And guess what else? If it was not assembled, if the final assembly of that vehicle was not in the United States, it also is not deductible. So now I tell you what, don't be asking your tax preparer where was the final assembly, okay? You need to find out where was the final assembly. We're not getting ready to look for the final assembly on no vehicle. The VIN, that VIN number, they say it's the VIN number that tells you whether or not the final assembly was in the United States. Well, now, whoever you bought the car from, ask them. Based on the VIN number, was my car assembled in the United States so that I can take this, okay? It also says, if you look here, it also says that the vehicle has to weigh less than 14,000 pounds. So don't be buying no new tow truck and think you about to, take off this interest, okay? This is for your regular cars, All right. So they also have an adjusted income limit. Look at that. If you're single and making under 100,000, you ain't getting it. It's gonna get prorated. You're not gonna. It's gonna phase out. Let's put it that way. Married couples, 200,000, it's gonna phase out. So you're not gonna get up to $10,000 in a interest deduction. It's called car interest deduction. But like I said, it has to be brand new. It has to be a personal car. It cannot be a car. Oh, I drive for Uber Eats, or I drive for Lyft. No, this is not a business car. It has to be your personal car. Okay, a brand new personal car. That is part of the big beautiful bill. So if you're not in that situation, then don't even bring it, okay? Because it's not gonna work. Now, I have done a tax return this year that the person actually brought the letter from the dealership that told me that this car was assembled in the United States and it was a 2025. It actually was a Mercedes Benz, believe it. It was actually a Mercedes Benz that its final assembly was in the United States, and therefore the interest was deductible. I did get one of those this year. Anyone have any questions on this part of the big, beautiful bill before I get into my next one? And this my next one, my next favorite one. But I just want to make sure there's no questions asked before I go to my next beautiful bill. None. All right, so we're gonna go to the next one. And this is for my senior citizens. So my senior citizens, I'm sorry, yeah, senior citizens definition is 65 or older. But it's also based on your income. So this is what the government did when I showed you on my scenario earlier about taxes. If you're 65 or older, yes, you get to reduce your income by another $6,000. And look at in red. The piece in red tells you you do not have to itemize your deductions to get this benefit. We're going to automatically reduce your income by $6,000 if you're 65 or older. And if you're single, you could not have made over 75,000. If you did make over 75,000, it phases out. There's a gradual phase out. You will get some of the 6,000, but you're not going to get it all once your income exceeds 75,000. Likewise for married couples. Now, if only one of you is 65 or older, then you only gonna get one $6,000. But if both of you are, then you go get $12,000, and that's providing as a couple, you did not make over $150,000. If you did, it's going to get prorated again, so that you're not going to get the whole $12,000 off. But it still makes a big difference whether they give you the 6,000 off or the 12,000 off. I saw it with my own two eyes that I have folks this year, especially my seniors, who actually benefited from this extra deduction because a lot of seniors are not itemizing anymore because they're not they don't have the mortgages. Let's put it that way. And it is hard to take off medical unless it exceeds 7.5% of your income, and that's out-of-pocket medical is very hard to take off unless it exceeds that amount, right? So, but that's a very good benefit under this big beautiful bill. So I'm gonna give kudos to Schedule A, that first bullet you see up there, and that last bullet you see for senior citizens. We're going to give credit to that as well. So for those three bullets, does anyone have anything they didn't understand that I have said before I get into my I think I still have two more bullets I want to go over for the big beautiful bill. But to make sure you are clear and understand, number one, you have a better benefit for itemizing under taxes on Schedule A. If you bought a brand new car in 2025, and it was assembled in the final assembly was in the United States, and you meet the income limits, you'll be able to take up to $10,000 off your income in the way of car interest. And then if you're a senior citizen, 65 or older, it's also income driven, but you'll be able to deduct an extra $6,000 a piece off of your income, and you do not have to itemize to get that deduction. So I'm finished with those three. If there's no questions, I'm going to move on to the next one.
Gwen,
Yes.
yeah, Sheila Dodd put a comment in the chat. She said, VINs that have 1, 4, 5, 7F through 7Z and 70 were assembled in the USA. Location applies to the first 1 or 2 numbers of the VIN.
Okay, thank you very much. So anyone else that needs to know that, can you just repeat it for them so they'll have it, please?
Sure,
It's
VIN,
in the chat.
it's in the chat as
Oh,
1,
it's in the
4,
chat. Okay.
5, 7F through 7Z and 70. And also, Dr. Stubbs has his hand raised.
Okay, go ahead.
I came in late, so I want to clarify that second bullet about the deductions for senior 65 and older.
Yes, ma'am.
Is that something separate from the autos? It's just that you now can qualify for this additional deduction just because of age?
Yes, it's a separate deduction that's on. We have a line item on our tax return now that says if you're 65 or older and you're single, we can reduce your income by an additional $6,000. That has nothing to do with the standard deduction. It has nothing to do with whether or not you itemize. Your income goes down by an extra $6,000, providing you meet the income requirement. So if you're single and make 75,000 or less, you will get all 6,000. If you're married filing jointly and make less 150,000 or less, then both of y'all will get the 12,000 total between the two of you, 6,000 each. So it prorates downwards as you make more over those limits. Did I answer your question?
Yes, and thank you.
You're welcome. Any other questions before I move to the next part of the big, beautiful bill? Okay, here we go. All right, so the next section is about these people who made overtime. Overtime, tax on overtime, okay? So this is what's happening. All right, so they don't explain this very well, but I actually work for a company where we do have persons making overtime, but the reason why this company did not qualify for the no tax on overtime is because of their pay frequency. So understand this. If your pay is every week, every other week, or once a month, then this bullet applies to you. But if your pay is only twice a month, some people like the state, federal government, we only get paid twice a month. You get paid the 15th of the last day of the month, or you might get paid the 1st and the 15th of the month. It doesn't apply to you. I can't explain why. I'm just a messenger. That they didn't offer the no tax on overtime if your pay frequency was not either the weekly, every other week, or monthly. So the company I work for, they're exempt. They are not getting the free money, the tax, no tax on overtime. But here's where you cannot make the mistake. Two things. One is there are some companies that when this law came into effect, July 1, there are some companies who did take note and kept track of how much qualified for overtime for 2025. And they passed out letters, they gave out notices to the employees to say, give this to your tax preparer. It shows you that this year The overtime that's exempt for you is $5,000, for example, or $2,000, whatever the case may be. The company gave them the letter. But then I have some who made the overtime, did the overtime, and they were not given a thing. And the company said to them, oh, well, we're going to start doing it for you next year. We'll be able to tell you in 2026. For the end of 2026, we'll be able to tell you what your overtime is that qualifies for this bill. Well, the government is allowing you to compute it yourself, but you have to know how to compute it. And that is why I put this up. I said, if you make $20 an hour normally, but your overtime is time and a half and we paid you 30, the only part that's exempt is the $10. You don't get to write off the whole 30 because the first 20 is your regular pay. That's not overtime. That's your regular pay. The only thing that's overtime is the additional $10. So you need to know that first, that what did I get paid per hour minus what is my normal pay per hour, and multiply that by the number of overtime hours worked. Okay? They also tell you that there will be a maximum deduction of $12,500 for single and $25,000 for married. But as with all things, there's a phase out. So if your adjusted gross income for single is 150 or more, you will not do no tax on overtime. It will not be exempt if your income is too high. Same thing with married couples that make $300,000 or more. You will not be able to deduct for the overtime pay. So I have a tax client that didn't tell me until after the taxes was filed that they had overtime that they should have given to me. Okay, so now we got to wait until their tax return has been processed before I can file an amended return to the government saying, hey, I had overtime that was exempt. So therefore, this is my new tax return, and so they owe me money back. It's not saying that that's not okay, because it is okay. You had 3 years to file an amended return. So you can still file an amended return if you missed it and you know you were entitled to have it. But just don't worry. If your job does not give it to you, then you can compute it. Now, this should tell you that this is for persons only who are working. I don't want to hear nothing from nobody receiving retirement, 1099s, and Social Security. This ain't got nothing to do with overtime. A 1099 or retirement money is not earned income. That's not earned income. And neither is Social Security. You did not go out and earn it. We did earn it, but we're not currently earning it. We're receiving it as a benefit because of the time we work. This applies to those receiving a W-2 form because they are actually going to work. So we can only exempt overtime for those who are truly, truly working overtime currently. Does anyone not understand? No tax on overtime. Is there anyone that doesn't understand this part of the big, beautiful bill? Or does anyone have any questions? No questions. Okay, because the other one, beautiful bill, is that they have no tax on tips. So the IRS is the one who has identified what's considered customarily and regularly receiving tips. And we all know that's restaurants. We all know that's waitresses and waiters. We know that. Okay. So it's showing you that they get a maximum deduction of 25K, but they can't make over 150,000 single or 300,000 married. Okay, so the government is allowing them to eliminate tips, tax on tips, providing they meet those qualifications. Any questions on tax on tips? So before I move on to the state, this is the state of Virginia, which is where I'm going next. Let's talk about anything that I've already covered, especially if it's fresh right now. Feel free to raise your hand if you have anything you need me to go back over that deals with the federal side of this house, because in a minute I'm going to the state side of Virginia to talk about what they're doing and not doing. But I've covered a lot here with the big, beautiful bill and the things that we need to be aware of in filing your federal return so that we try to pay the least amount of money to the IRS. The main thing here we have to understand when it comes to paying taxes, the smarter you are, I'm not saying anyone's dumb, but the smarter you are in trying to get that income down to as low a level as possible means that you have done your work, okay, to get that income down. And we have ways to get the income down, but some of us don't, we don't get into it. We just accept it, whatever the standard deduction is, that is what it is, okay? And I was trying to show you that if we just did a little bit more homework sometimes, how we can change our tax rates because we did a little homework. And even if it was to clean out the closet, because I'll tell you in a minute, we have so much over time as life goes on. I can guarantee you that most of us sitting up here listening to me right now, I can guarantee you that most of us probably got something up in that closet, in the garage, up in the attic that, hey, it will be there, I guess, till we die, because we ain't fixing to move it. It's just there. But it could be worth something if you would just take it to Goodwill, Salvation Army, and maybe possibly value it so that it can reduce your income. You understand what I'm saying? Reduce your income so that we pay less tax, right? And there used to be, because I know for years now, I've been telling y'all, and I've got to find a new one. I haven't found a new one yet. But Intuit, which is INTUIT, Intuit used to have this mechanism called It's Deductible. It's deductible. So we used to be able to go on the It's Deductible and tell it, look, I went to Goodwill on March the 15th, and this is what I gave them. I gave them 10 pairs of jeans. I gave them 20 women's blouses. I gave them 15 pairs of shoes, and the thing valued it for you. So that at the end of the day, it said, oh, well, based on what your inventory you just gave me, you have deduction of $3,000, for example, that can be used to reduce your income. Now, what gets me, so you'll know, is that you can't just say, well, what did I deduct last year? So just raise it a little bit for this year. You can't tell a tax preparer, okay, so tell me what I deducted last year, and you go and raise it a little bit this year. Because you know what? Your tax preparer cannot come up with the value of what you gave away. We can't do that. You have to tell us. And the best way to tell us is by inventory. Because I tell you what, the moment you take a Goodwill receipt, and even though to me that's a loophole, so that is a big loophole, but I'm not gonna get into it but too much, but that's a big loophole. The minute you take a Goodwill receipt and you say, let's value that receipt at $1,500. All right, well now if you get audited, they're gonna ask you how did you arrive at it? How did you determine that that receipt was worth $1,500? Just so you can reduce your income? No. You have to have had an inventory or make up one right quick, because without inventory, there was no way to calculate $1,500. You can't calculate $1,500 if you don't have an inventory. So did you give away a bedroom set? Did you give away a computer? Did you give away clothes? What did you give away? You just can't say $1,500. You gotta say what? And for my folks with these special small, I'm gonna say small businesses, that we have to fill out what's called a Schedule C that shows the government, okay, so I brought in X amount of dollars and I spent X amount of dollars on this. Well, you can't say that you're a photographer in the business of being photography, and you're going to say, well, this year I didn't make any money, but I traveled to Paris to take some pictures. We ain't paying for you to go to Paris and take pictures, and you ain't bringing no money. Okay, so that doesn't even make sense. But if you turn around and say, well, no, I didn't make any money as a photographer, but to start my business, I bought a camera. I bought some film. I had to buy a computer. I got some paper, whatever. That makes sense, if you understand. But then you can't then turn around and say, well, the paper was about $30. You guess what? Your receipt should say the paper was $28.29. Okay, the paper was not exactly $30. That is a guess. But when we have true receipts, we are able to calculate what it costs, and that makes a difference. Hand up, Zelda. Do you have a question?
We have a few questions.
Yeah,
Okay.
I'll take in reverse order here. Pender, her question is, what was that website again?
Yeah, the
The web-
website is no longer operable. It's deductible.com.
Yeah, it's the
You have another one?
I don't have another one. I haven't looked yet.
Oh, it was a
But I
good
mean,
website too.
Yeah. We need to do a search
Mm-hmm.
or Google
Another
contributions. So
one.
it's non-cash contributions is what it is. So you need
Mhm.
something that calculates non-cash contributions.
Mhm.
Because that was a very good one. I'm sorry I didn't have time to get into it because I'm in tax season right now. My brain is somewhere else. But that
I'll do
was
some research on that.
okay. Thank you.
And then James Carney, he asks, can you explain what makes up adjusted gross income?
Sure. Okay, so adjusted gross income is where it takes all of your gross money first. So your gross money is money that's been reported to them in the way of W-2s, 1099-Rs, which is retirement money, maybe Social Security. We have some people who are receiving money in the way of interest or dividends. You also could have rental property that has a net profit on it of $3,000. The point is that you have to come up with your gross money first. But to arrive at adjusted gross income, the government allows people to reduce their income by certain things. And the first two that come off my brain at the moment that I know are deducted to arrive at adjusted gross income. Number one is if you're putting money into a 401k that you have done individually. It's not money that your job took from you to place into a 403B deferred comp. I am talking an IRA where you have opened up your own account and you have placed money in that IRA. That is a deduction to arrive at adjusted gross income. And for those of you, hopefully nobody on the phone, no one on this call is going through this, but anyone who's paying alimony, you also have a deduction to arrive at adjusted gross income if you're paying alimony. So those are two I could think of on the top of my head that will reduce your gross income down to adjusted gross income before you're allowed to reduce your income by either standard deduction or itemized deduction or the additional $6,000 for 65 or older deduction. Did I answer James' question, James?
Yes, thanks, Gwen. And also I Googled it. It said educator expenses. Is that one too?
Yeah. There's possibly that. I can only think of the two. I don't have all of them in my brain,
Okay,
but those are the two. The ones I gave examples were the two I knew.
okay,
Okay.
And
okay, thank you.
also, Dr. Stubbs just she said, found this non-tax calculator, and she puts a link in the chat. So,
Thank you, Dr. Stubbs.
You're
Thank you,
welcome.
Dr. Stubbs.
and then Mary Macbeth asks, what about folks who get cash tips that don't show up on W-2?
All right, so that's just like my hairdressers who are collecting cash for doing my hair, because cash is hard to trace. Cash is hard to track. You can do something crazy that makes it trackable. Let's put it that way. But it says that it includes voluntary cash. I can't sit on here and tell you that you shouldn't report it. That's just like a lot of you may not know, but if you work, say you go provide a service. Let me pick on a groundskeeper. So let's say a groundskeeper provides a service and cleans up the snow. One time they go clean up the snow at the church, and we paid them $700 to clean up that snow. And let's just say that the law up through 2025 was that if that person was not a corporation, we were supposed to give them a 1099 NEC at the end of the day that reported to the IRS that we paid that person $700. But we didn't, but the church didn't give it to him. The church did not give it to him. The question then becomes, should he report the $700 or not? That $700 or not is actually based on his honesty. Although the church really should have given him the 1099, the question would become, did you get it? The IRS would ask the groundskeeper, did you get it? How does the IRS know the groundskeeper got it? They will only know if they audited the church books and saw a payment written to the groundskeeper and then said, where's the 1099? That's the only way they would know. What's the probability? I can't answer that. I don't know the probability. So the answer is you should be honest, even though it's cash, because the question is, did you get it? Because I'm going to tell you what happens in the long run. In the long run, what happens is that if you normally are a person that banks your money, there's nothing the government doesn't see and doesn't know if it filtered through a financial institution. So now I'm going to go back to my hairdresser. How are you going to say that when you did hair or I'm picking on a beauty salon. If you beauty salon, and this year the beauty salon, you say I brought in $30,000. Now you probably brought in 100, but let's just say the beauty salon says I brought in $30,000. How can you say that, but you got a mortgage of $2,000 a month? If you're paying mortgage at home of $24,000 and you got to eat, you got to put gas in your car, you got to clothe, and then you got 2 kids at home. How? You can't pay that with no $30,000? No, really. Think about it. They won't put 6,000 left. So that's telling the government, no, you know what? You got more than some $30,000 going on, because there's no way you could have paid your mortgage, insurance, and everything that goes with maintaining a house, and be able to live every day and eat off of $30,000 and 2 kids. Absolutely not. So, cash, although it's hard to trace, it can be traceable if you're placing all your money in a financial institution. Or how about this? Keep swiping your debits, paying for this and paying for that. They see everything. Put it up on your credit card. They see everything. There's nothing they don't see. But I do want to tell you this one thing I did find out, though, about that 1099 that should have went to the groundskeeper that made $700. So starting in the year 2000, businesses no longer have to give you a 1099 NEC if you made less than $2,000. So it's going away from the 600. They raised it to 2,000 to save on the paperwork. But does that mean it's not reportable? The answer is no. It is still reportable. But reportable maybe as other income. And I'm gonna tell you what the difficulty is going to be. Okay, so I already know this for a fact. Those of us who are filing taxes, when it's time for us to report income, even if it is other income, we can't show it without a federal ID number associated with it, unless it's interest, dividends, or your own personal business or real estate. We have no way of keying in that you made $700 as a groundskeeper, and where we're going to put it on your tax return, and we don't have nothing to identify who gave it to you. So now it makes it like impossible to report the cash, because we have no way of reporting cash unless we've been given the document to report it from. That was a good question, Marion. Thank you.
And also there, Dr. Stubbs and also Tony Moss, they mentioned the slides. They would like to get copies of slides. We answered yes. So, we will facilitate getting the copies of the slides to everybody who needs that. How do we do that? Okay.
We'll get it done.
We'll get it
But
done.
we have some more questions.
Okay.
So
Colette Jenkins asked,
are you on my question now or not?
Dr. Stubbs? Okay.
Go ahead, Dr. Stubbs.
I read that when you are retiring, you can make a large donation to your employer pension. For example, if you're working at a facility and have a retirement plan and you are retiring and you're over a certain age, I'm not sure what that age was. I don't know if it was 65 or if you were in your 70s, you can make a big donation, something like several thousands. I want to say $20,000 to $30,000. Might be, some restrictions in there. I want to know if that is accurate, and if you don't have a large employer, if you don't have a large employer, but you had your own company and you had a SEPT account, can you do the same thing for your company?
Yeah, and I actually don't know and haven't heard that before, because as soon as you said donate, to a company that you said does not have a retirement? Is it so? Are you talking about placing the money in an account for your own benefit or for the benefit of the company? That's where I was
No.
confused. That's stuff.
Okay, let me clarify that. If you're with a company and you have a retirement plan with that company,
Mhm,
and you usually put a certain percentage of your income into
mhm,
your own personal retirement
mhm.
account, the last year of your working, like the year that you are retiring, can you put in more, like a lump sum into your own retirement for your benefits if you're a certain age? And if you could do it.
Okay, so I, yeah, I do know that when it comes to an employer, there are limits on how much can go into the 401k, the 403b, and they usually have, and because those are two different types of deferred comp plans, each of them has their own limit. I don't have those figures in my head, but each of them have their own limit on what can go into that. The only way you can actually open up another account, you mentioned the SEP plan. So the SEP plan is for those who have businesses that wants to open up a retirement account in the name of the business, well, the name of a person that works for the business. However, the problem with it's not really a problem with the SEP plan and put money in it. The problem is that if the business does not make money, then you won't be able to deduct it. So you can't have a business showing a loss and think you're about to take off the deduction for putting money in a SEP plan because it don't work that way. Your SEP plan is based on a certain percentage of your profit that can go into the retirement. Okay. And then the other thing that can be done, I do know that it's called the catch-up period, right? So a catch-up period is where after we turn age 55 or older, and if we have not placed enough money into our retirement accounts for the future, I think there are accounts out there like places like Fidelity Investments, Neiman Marcus. There's different ones out there where we can open up a 401k, an IRA, or whatever, and place money in there as a catch up for retirement because we're 55 or older. So I don't know all the figures off the top of my head, but I understand what you're saying, Dr.
And
Stubbs.
then my last part of this question is, if you are still making money and you're over 72 or 73, can you still put money in a Roth account? No, that won't bring your taxes down. Can you still put money in an IRA or a SEP account if you're in your 70s so you can bring down your taxable income?
Okay, so and that's a good question too, because see what happens is I guess everyone knows that for the past few years, the IRS has kept raising. They kept raising the amount of money that a person had to start deducting or receiving from their 401ks, their 403bs, their deferred comp plans, and it's called required minimum distribution. So required minimum distribution meant that it's based on your actuarial. So say for example, everyone has a life expectancy. So they've got these tables that I'm talking about the financial institutions. They have these tables that tell them, okay, so based on your age right now, we expect you to live another 10 years. And based on the money you have up in this account, we divide it and then we give you so much per year until you exhaust all of your funds out because that's what we call required minimum distribution. So they raise the age up to 73 now. And I think I'm not sure, but I don't know why it makes sense to even place money, additional money in that vehicle to be made to take it back out. So that I understand what you're asking me, but logically speaking, that would make sense to me to place more money in that retirement account to be forced to take it right back out. Because if I'm forced to take it back out, I have just increased my taxable income because now the amount of money sitting in that account is higher than what it was for the required minimum distribution.
Hey,
I'm trying to answer you as best as I can, but
hey, Gwen,
Yes.
Right after Dr. Stubbs had that question, Kira Deloach, who presented to us previously,
Okay.
put in their 55 catch-up contributions. So, Ms. Deloach, I don't know if, are you able to speak on that at all?
Yes. So what she was referencing, once individuals get to the age of 55, they're eligible to start doing what's called, as Ms. Carney mentioned, catch-up contributions inside of their qualified retirement accounts through their employer, to get them on track if they're not off track with retirement. So is what she elaborated or alluded to a few minutes ago also. But Ms. Stubbs, some of the questions that you have as well, those do, as Ms. Carney also mentioned, kind of tie into what some of the financial institutions do. So yeah, that's all. But Miss Carnegie, she kind of hit it on, Miss Carney, she hit it on the head as far as the catch-up contributions and kind of how those work after you get to a certain age. However, it's not something that can be taxed unless it's inside of a SEP IRA that was also mentioned. And again, like she mentioned, you have to put those contributions into your business account in order for them to be deducted as countable, be deducted from your gross income. And so there are some other stipulations that go along with that to make those tax deductible, but that'll be kind of a separate conversation when it comes to how to set up and open and make contributions to a SEP IRA.
And Mr. Loach, for those of you who did not get the benefit of hearing you present, remind everybody who you're with and what you do.
Yes. So New York Life is the financial institution that I am with. I did hop on today because, again, a lot of my clients are also in need of CPA services. So, Miss Carney, I will definitely be getting with you after this conversation. But I work hand in hand with CPAs to help my clients when it comes to their financial planning and retirement planning pieces. So, yes. And again, I'm with New York Life.
Thank you.
Thanks.
You're
And
welcome.
Gwen, are you ready to move off that topic? We have a question on
Another
another
question.
topic that we can get to if you.
Okay, yeah. So you have another question? Go ahead.
Yeah, Chloette Jenkins asked, can a travel agent get a deduction for trips they take for training and monthly membership fees that are paid, even though they have no earned commission income?
Okay, so usually, as I was saying earlier, a lot of times when we start a business, there, it is automatically understood that there will be startup costs to operating a business. So it is okay to kind of spend more than you bring in, but I tell you what, you can't keep that going like that, because after a while, if it looks like a hobby, it is a hobby, and if it gets called a hobby, then it will be denied sooner or later by the IRS. So that's the way that works, because whatever it costs you to generate the money for that business, it should be deductible. But there are going to be times where we do spend more to get started. And no, we're not showing income, but eventually we should be, because nobody goes into business to be a nonprofit. You go into business to make a profit. And that's exactly what the IRS is looking at. You should be making a profit. I don't care if it's $5. You need to be making a profit sooner or later. Next question.
All right, and T. Mitchell says, quick search on apps or websites that calculate non-cash contributions produce the following. He lists, it's a www.donationcalc.com. Many Google sites have calculators. Salvation Army has a commonly used valuation guide. Tax software tools like TaxAct, Donation Assistant, H&R Block, Deduction Pro. So everybody just go to the chat and you can see what he posted there. I'm sorry. Apologize.
Okay, thank you. All right, are we ready to learn something about the state taxes? We're finished with the federal now.
Yes, ma'am.
Yeah.
Okay, because I ain't got but 30 minutes left. Okay, so what you need to know for this tax season in the state of Virginia. Let's start with the fact that the standard deduction It's $87.50 for individuals and married filing separate returns. It's $87.50. All right. It's the standard deduction is $17,500 for married filing joint returns. The filing deadline that should say May 1, 2026. I'm sorry. But there is an automatic 6-month extension with no need to apply. But taxes due must still be submitted on time. Now, this one for veterans. I've been doing this for 4 years. This is the 4th year I think we've been doing it. And every year it raised. But those who are receiving military pay as retirement on the state return, there's a section there where we get to key in how much your 1099-R says your military retirement money was. And for the first 40,000, it reduces your income on the state return. Has nothing to do with itemizing, ain't got nothing to do with standard deduction. If you were 55 and older as a veteran and up to $40,000, you will not pay taxes on that money. But I got a note here for you, because one thing is for sure, we have a new governor. That was Youngkin's promotion. And so he's out of office now. So I can't speak on whether or not this will carry over for 2026 when it's time to file the taxes for the year that we're sitting in right now. So that was just to give you a heads up that this year it is 40,000, which is a big deduction for those who are military retirees receiving a pension. Okay, any questions on that so far? I'm still going to stay on the state of Virginia. I have a little bit more to cover. But I wanted everyone to see at least that. And just remember the filing deadline, that should say 2026. So I want you to see the taxable income rate. There are 4 rates. It doesn't matter. Like I said earlier, you could be single, you could be married, you could be head of household. It does not matter. We pay taxes based on how much taxable income is available at the end of the day. What is the taxable income available that you're going to have to pay taxes on? And look at that. A lot of people are paying taxes at 5.75% over 17,000. So hopefully you have taxable income over 17,000. I mean, that if you think about it, that's a low number. So a lot of us are paying taxes of 5.75%. But it's actually based on this. It's based on what did you get your income down to on the federal. Because you can't file, you can't file state tax return unless the federal's filed. The federal has to go first. You can't tell the state, oh, send me my money. No, you need to file the federal to arrive at your adjusted gross income, to arrive at taxable income, and then we file the state return. So anyway, I wanted you to see that for 2025. The other thing you need to know is that the state of Virginia does allow the Virginia College Savings Plan, $4,000 per year. And that is a tax savings. A lot of us grandparents have these accounts for our grandkids so that we can deduct the money on our state return. So this actually includes these 3 plans that Virginia College Savings Plan allows us to invest in so that we can reduce our income on the state return. The other thing that the state of Virginia offers is that there are additional deductions for those if you were not able to itemize. So if you look at this, you'll see that even though we're supposed to, if you itemize on federal, you have to itemize on the state. But the state also, if you were not able to deduct certain things on the federal, you were allowed to deduct it on the state. one of them here is talking about the unreimbursed tuition costs. But my favorite, to be honest, is this very next one. My favorite is see, I know I'm not an insurance agent, and I remember back in the day, the insurance man used to come to the house to collect the money from my parents. Like is low as home, you know. Because back in the day, we were so hung up on death benefits. But we really need to be concerned about long-term care, because the probability is that we're going to need long-term care before we're going to need a death benefit. And a lot of us can't deduct long-term care on our federal return, because if we have medical deductions on federal, they have to exceed 7.5% of our income. And we can't deduct the long-term care premium. But if we key it into the website, key it into our software for the tax return, the state sees that the long-term care deduction was in the file. It picks it up on our state return and allows it to be a deduction that you would not have otherwise had. You have another question, Kara?
No, I'm applauding that. Long-term care as a female, I cannot express the emphasis on that enough. So yes, I just want to allude to yes.
Thank you.
You're welcome.
Because all we hear is you guys insurance in case you die. Well, you don't need enough to bury you. Who the devil cares about the rest? I mean, what you gonna do? But when it comes to long-term care, we need to be taken care of.
Right. Very true.
Whether we're at home, whether we're at a nursing home, whatever, and that's what costs. It costs thousands of dollars. I ain't talking about something that costs $2,000 a month. We're talking $8,000 to $10,000 a month for someone to have long-term care. What happens if you don't have the insurance? But I'm not an insurance agent, like I said, but I'll just let you know that the premiums, though, are deductible on the state if you were not able to claim it on your federal. That's what I was trying to say. And then for those of you who bought some energy efficient equipment, it's not 20% of the cost of the equipment, okay? It's only 20% of the sales tax on the equipment. That's the difference. That's a much smaller number. Whatever the sales tax was on it, you get 20% of it, up to $500 a person, and if it's joint, is up to $1,000. You get to deduct on your state return. That's not deductible on the federal. What's deductible on the federal is a residential credit for efficiency, which is a whole nother subject I didn't get into. Any questions on these three items before I take you to things to help you get ready, so you can avoid delaying your return? Because we can delay a return not realizing that we have. So sometimes we just got to do a little homework before we do our tax return. That's just not something you just sit down and do. And for those of you who go to preparers, I'll tell you this: the more organized you are in your presentation, the better. Because when you hand someone a bunch of paper, slips of paper, like we supposed to sit and add it up, like we know what we're looking at, guess what? It's gonna take a minute. Matter of fact, some of us gonna get right back to you. How about that? Because I don't have time to sit and add up nobody's numbers, okay? So you should be able to present it correctly. So I'm gonna show you how in 1 minute. Any questions on this before I move on? Yes.
When she finished, I'll be ready to go.
I'm sorry.
You have a question?
Dr. Stubbs. No. Well, Rolanda Coverson, and when you were all talking about the insurance for long-term care, she put in there, absolutely. So took that as an amen. Took that as an amen.
Yeah, amen. All right, so I'm gonna take you now to my suggested steps to take you to get you ready for filing your taxes and avoid your processing details. So the IRS.gov has numerous online tools. So you can get answers to some of your tax questions by just going to irs.gov and do a little homework. It is harder for a preparer to do a lot of research in tax season. That is not the time for, I know sometimes we got to like hurry up and answer a question or two, but it's not the time to dig into a lot in detail because of the volume of taxes at this time of year. So it's always good to go online and research yourself sometimes because you can be a help to your preparer, because I said from the very beginning, we don't know it all. There's no way we know it all. But this is one suggestion: to gather all your W-2s, 1099s, interest income, Social Security. I actually had two people yesterday. I had to email them. I said, last year you had a 1099 from OPM, Office of Personnel Management. Where is it this year? I know they ain't stopped giving you your retirement money. Said, oh, I forgot that one. Okay. Well, we were required by law to keep copies. I keep copies of what you gave me the year before for the income piece of it, but I only keep it for 3 years. I'm only required to keep 3 years. So good thing I keep it, because I wouldn't have remembered that you had something from OPM. I had to look back. My system told me you had OPM. So we have to gather everything that we had from the year before, unless something changed. If something changed, like you start working somewhere, we get that. You wouldn't have a W-2. You also need to gather your information, and these are just some of the categories you need to gather. But why would you hand a tax preparer, for example, every slip you got because you contributed $25 to St. Jude and $50 to Save the Pets? Why you can't itemize, write down what were your contributions and total it? Why can't we tell the tax preparer, oh, my contributions were $5,000. Church represents 3,000 of it. This one represents whatever. Instead, we're handing them papers like we're supposed to come up with the figure. We're supposed to come up with the contribution. No, you should know what your contributions are. That's like handing somebody a goodwill receipt and you and telling me to value it. I can't value your goodwill. You better value your goodwill. I ain't go with you to the Goodwill store. So I wouldn't know. Now, filing taxes electronically is the key, because those who are preparing, I think if we prepare 5 tax returns or more, we have to e-file every one of them. So there's no question about it. We have to e-file them. And it needs to go into a bank account, a prepaid debit, or a mobile app. As long as you got a routing number and account number, because they don't like doing them checks. And I think the state, if I'm not mistaken, I think the state stopped doing them. I don't know what people do, because I think the state of Virginia stopped issuing checks. But anyway, you definitely want to electronically file this and request your deposit to go to your bank account. Next thing, file early. Now, those of you all that wait till April, I don't know what to say. And especially for those who owe. Because, see, I don't want to know about it on April 15th. I need to know before that what I owe. Because April 15th, they want their money. But if you're requesting earned income credit, your return's going to take a little longer, because they got to make sure it's legit. Because people will make up stuff in a minute. The one thing they did stop, though, is that now we have always had to, like, record a person's Social Security number, of course, their birth date and all that good stuff now. But they also have a checklist. I'm talking about, when I say they, I'm talking about the IRS. Now has a checklist for preparers where we have to answer certain questions. Did we ask you whether or not your child was living with you? You know, we have to ask certain things to make sure you are legit as well. Like we're the watchdog for the IRS as well, to make sure that you did qualify for earned income credit. So there's questions we have to ask. Here are a couple of things you can download if you want to check on the status of your refund. Your tax preparer cannot go online and pretend they you and see where your refund is. You can go online and find out where's your refund. You just have to have certain information, and you should have the information because you should know whether or not you filed single, married, whatever. And you also should know how much was your refund. Now, don't go in there and tell them about $5,000, the refund won't put two, because it's going to put you right on out. If you don't know exactly what your refund was, you're not going to be able, because it can't authenticate you. It has no idea that you are who you are if you can't answer like even the littlest question, what is your social security number? Now, if you don't know that, then you really gonna have a problem. But so I'm just letting you know. But one of my favorite things that the IRS has, and I think this is something we all should have, is the identity protection opt-in program. And that's because I have clients who, when I go to file their tax return, if I have not put in a 6-digit code that was given to them, and they get a different one every year. So it's not the same every year. They get a different code that is mailed to them every year. If they don't give me that 6-digit code, the tax return will not e-file because people are fraudulent out here now. They go on and act like they're you. If they have just a little bit information, they file a tax return like as if they're you to get back money. And now some of them I don't understand why the IRS didn't catch them, but I'm not going there. But that protection program is very well widely used, and I would recommend using it. But I think we all should be required to have it, the 6-digit code, because that will cut down on fraudulent activity of people, taking our identity, just like they do with credit cards, stealing your identity. They also do it with tax returns by getting back a refund that you weren't even entitled to have, and neither were they because they're not you. All right, so now I'm not gonna say this is my favorite part that I'm getting ready to go to right now, but it's your opportunity to ask any more questions while we still have 12 minutes, 13 minutes, whatever we got. If I haven't covered something, but if I know the answer, I shall answer you. And if you have any questions, I will try my best. Dr. Stubbs. I see Dr. Stubbs, but she's not answering.
Her question.
Your question's in the chat. She says, can you suggest some different companies' ID protection programs?
Oh, so no, that's the federal government. That is only by the IRS. You have to go on that website to actually sign up for it. So you just put it in irs.gov's website. That's the only.
I didn't realize I had muted myself. So
Okay.
what I was trying to say is that I have looked at identity protection programs, and some of them don't seem robust enough. I was wondering if you or somebody in the on this chat has a company that does more than just look to see did somebody take a mortgage out. It was something very minor that I didn't think would give me very much protection. It was with one of the credit card companies.
Okay, so All right, so I'm not familiar with that. So, because the one that I was referencing was only to protect anyone from filing a tax return on your behalf and it not being you. This has nothing to do with credit cards, credit out there with other companies. This is strictly the IRS and protecting your tax return. That's the only one I referenced was the IRS.gov. That's the only thing they do is to give you identity code only to prepare your tax return. That's it. So I'm not aware of other companies personally.
Oh, okay.
In
So
in
the
the
IRS,
chat, oh, I'm sorry.
the IRS.gov site will generate a code that we can give to the accountant. So the accountant will be able to access our account, but not other people who don't have that code. Is that
No, so no, allow me to explain again. So the IRS on the IRS.gov, they have what's called an identity protection opt-in program that you have to sign up directly with the IRS. So you're going to be doing an application with the IRS to receive that 6-digit code every year. And
oh,
I'm saying that you have to then give that 6-digit code each year to your tax preparer in order for your taxes to be filed.
oh, okay. Thank you.
You're welcome.
Dr. Stubbs in the chat, Winona Washington says, I utilize ID Shield for protection, just in general.
Thank you.
Mhm. Now, are there any other questions?
So can you tell me how to place can you walk me through how to place this in the chat, or you want to, I'm talking about my slides from where I am. I'm able to put it into the chat from where I am. I'm not familiar enough. Maybe my husband might know,
Mhm.
but I don't
You
know.
can make a copy of the link.
Okay, so if I do, oh, you said I can make a copy of the link.
And then you can paste it into the chat.
Okay, so let's see.
Or does anyone else know how to do
Hmm.
send
So
the slides in the chat?
maybe James will
Or you
come
can
down.
just send them to me. I can get them to everybody.
Okay. So you have everyone's information to.
Contact.
Okay, all right, no problem. I'll send it to you. All
Okay.
right, that'll be easy for me because I do know how to do that. Okay, so is there anyone that's okay? Jonathan has a question.
Yes, I'd like to thank Judge Johnson and Dr. Johnson and you, Ms. Connie, for an excellent program. This is a wealth of information. We need it. Our people perish for lack of knowledge, and you all are helping us tremendously. So I'd like to first just say thank you. And
You're
then,
so welcome.
secondly, as a question, what are your recommendations of best practices for small businesses, entrepreneurs who hire other people to help them out, and they pay them for the cleaning of the yards and plumbing and roofing and all of that. And the question is whether or not to file a 1099. What are the best practices in your experience on that, from the perspective of a small business owner?
So we're small businesses. We're caught in a catch-22. I say because, um, of course, the right way to do it is to actually provide those persons with that 1099 NEC. But I don't know if you were on when I explained that at one time that limit was $600 or more that you had to give it to them. And now, starting with the year of 2026 that we are in right now, that limit has been raised to 2,000. So if you have not paid them 2,000 or more, you do not have to issue the 1099 NEC, but that does not mean you cannot deduct it. It's still deductible to the business. No reason why you can't deduct it.
Thank you.
You're welcome. Anyone else have any questions? Because I'm in time now, because we have until 1 o'clock. Woo. So I got through it. Any other questions? Forever hold your peace.
Just a few thank yous in the chat. You're welcome. Thank you for coming. I just put on the screen our Spirit of Wealth Summit that we have coming up next month on April 18th.
That would
Yeah,
be-
Marion, can you read Marion's? She just sent us information
Yes.
about a book.
Oh, yeah, okay.
Marion said, an interesting book about negative impact of tax laws on African Americans with some recommendations. The Whiteness of Wealth by Dorothy Brown.
That's interesting.
Yeah, we put on the screen information about the Spirit of Wealth Summit that's being sponsored or presented by this ministry, the Personal Finance Ministry at Thirsty Bethel AME Church. It's going to be an all-day event at the church. A number of speakers on different topics related to personal finance, how to build intergenerational wealth, how to maintain your finances, to do so in a spiritual and Christian way. So it's free. It doesn't cost anything to appear, show up and get that information. We'll even feed you, give you a continental breakfast and a gourmet box lunch. And so it's going to be dynamic. It's going to be great. The keynote speaker will be Reverend Dr. DeFar Soares, and I know his name is familiar to a number of you. We spent about a year studying his book, Say Yes to No Debt. And he has agreed to come down from New Jersey and to give us his words of wisdom on finances, personal finances. And he's an incredible preacher. So he's going to be our keynote speaker. But again, we have people talking about day trading, insurance, starting your own business. Sheila Dye, who is on the call, I saw her name up here. She is going to be one of our speakers. She was our very first speaker, the Personal Finance Ministry, years ago, about 7 years ago, I think, talking about experience and getting out of debt and gaining wealth. And so we're looking forward to hearing her presentation. So if you have any information, we just put the link. There's a website where you can find all kinds of information about the summit. Please click on that. We'll keep it up for a period of time after we close out. Or if you need information, just reach out to us and we'll get the information to you. Any questions about that?
Yeah, Dr. Stubbs wants to know what time it starts.
8 o'clock. We're going to have breakfast at 8 a.m. and we're going to start with the sessions at 9 a.m. But we'll have about an hour to get some food, to talk. We'll have vendors there, sponsors, and you can mingle and
Fellowship, meet and greet.
Fellowship, meet and greet. Get yourself situated, and we'll start at 9 o'clock, and we'll just have presenters all day. We're going to be utilizing the entire church, the sanctuary, the classrooms, and the bell hall, if you're familiar with our church. Any questions, talk to us. Also, we'll get more information out to you, but there'll be opportunity. We have tentatively, we're going to square it down, but on the last Friday of this month, which is the 27th, we're finalizing plans to have a meet and greet with our presenters at the Black History Museum. Again, that's going to be free, but it's an opportunity for sponsors and for the presenters to meet the congregation, other people in the community who want to go. At the Black History Museum, some of you may know, they just started the Arthur Ashe exhibit. So you get opportunity to go to the museum and tour it for free, get some information about the summit. Hopefully we'll encourage you to register and participate. You can do that beforehand, but you're welcome to come. And some of you all, about 50 people, go to the Virginia Museum of Fine Arts this past Sunday, where again, to promote the summit, we watched the Swifties and Alicia Keys exhibit Giants at the Virginia Museum of Fine Arts. So we gave out free tickets to promote the summit. So we're working hard, trying to get you all some good information in a good way. So be on the lookout for all of that. Any questions, just go to the link that's in the chat. All right, anything else?
So just to let everyone know, this workshop was purposely recorded, so it'll be available out on through YouTube for Third Street Bethel. It will be there later. And then I'm going to send the slides to Zelda shortly, and she will email them out to those who are on this call.
Great. Thank you for saying that, Gwen.
Thank you so much, Gwen, for joining us.
You're welcome. No
we
problem.
always look forward to it.
Everybody looks forward to it.
But every year they keep changing stuff up.
Yep.
So if anybody wants a recording and needs to know how to get onto the church's YouTube site, and you can kind of go to YouTube and you can sort of find it, along with prior recordings. We have recordings of prior speakers up as well. Just contact us. We'll get you the link. Please encourage your friends, pass the link on to them. This excellent presentation and information that everybody should know. All right, are all minds clear? Any other
All minds clear.
comments? All right, so we're going to close out in prayer. Dear God, we are so blessed. We are so thankful for another opportunity. Thank you for Gwen Carney and her husband, James, and their whole family. Thank you for everybody who made it. It's good information. We are so thankful that we received it. But let us not use it just for ourselves. Let us pass this information along so that other people can get into a better financial state.
Yep.
People's churches and our church can get into a good financial state so that we have the resources that you require us to have so that we can build your kingdom. In your son Jesus' name. It's in his name that we do pray. Amen.
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 Thank you, everyone, for coming.
Thank you.
Enjoy the rest of your day.
Have a
Get
good
some
one.
sunshine.
70-some degrees out there.
Thank you. You too.
Enjoy your day. Have a blessed day, everybody.
Okay.
Thank you so very much.
Don't forget to cut off the recording, Zelda.
Okay.
Bye.
Bye.
Bye.